Mortgage rates. There's actually one benefit to high interest rates that I'm kind of shocked that nobody really talks about. For every 1% increase in mortgage rates, approximately 3 million potential home buyers are priced out of the market. And that number is even higher when you think about potential buyers who just get scared away from buying, even though they can afford a higher payment. But the benefit of fewer buyers shopping is some sellers will have to reduce their prices or even offer incentives to entice buyers to buy their properties. As a buyer, you can negotiate a better deal when you don't have to compete with so many people on the same property. This can make a huge impact on final price, and you can end up paying less, getting seller credits, so you can use for rate buy downs or closing costs. I want to talk about the 5-letter word that is probably the worst thing for everybody that earns income, and that's taxes. Specifically in this video, I want to talk about sale taxes. When you sell a property, what are you going to be looking at as far as taxes due on your income that you earned? So let's go through a scenario. Let's just say you bought a property for $200,000. You sold it, let's just say 3 years later, for $300,000. Over the course of those 3 years, you invested $25,000. You maybe rehabbed a bathroom, you fixed up a kitchen, you maybe redid some floors, and overall you spent $25,000 in those 3 years. So let's just say $25,000 spent. We're gonna also include a few other expenses to offset any gains that you've made between this original sale price and what you sold it for 3 years later. Some stuff that you can include are items like closing costs. And remember, it's not just one set of closing costs, it's gonna be two. Because remember, you have closing costs when you buy and when you sell. So let's just do some rough numbers on the closing costs. So the buying closing costs are going to include a number of things. It could be lender points, it could be attorney fees, it could be commissions due to your agents. So typically on a sale or purchase of a property, the agents are going to collect 2.5% to represent the buyer, 2.5% in representation of the seller, so for a total of 5%. And remember, you as the seller are paying those fees. The buyer is not paying any agent fees in a typical scenario. So on a $200,000 sale, if we're talking about 5% due to both agents, the seller agent and the buyer agent, we're talking about $10,000 in commissions. On a typical $200,000 sale or so, between $10,000 in commissions and other closing costs, which include the attorney fees and the lender fees and all that kind of stuff, I'm estimating another $10,000 in fees for a grand total of $20,000. So here we have our $20K total. And remember, this is the closing costs on the initial purchase, which was on the buying side for the $200,000 initial price. So now, remember, you sold this thing for $300,000 3 years later. Closing costs on that sale is going to be a little bit more because remember, you've got 5%, right, due to these agents on the buying and the selling side. So we're going to be paying more because you sold it for more. So 5% of 300,000 is 15,000. And $300,000 is not a huge difference from 200, so we're going to go with the same estimate for $10,000 in these additional costs for the attorney, title, and lender. So here we have our grand total of $25,000. So we've got our purchase of $200,000. We have our $25,000 in upgrades spent throughout those 3 years. We've got our initial set of closing costs for $20,000 and our final set when you sold the property for $300,000 at $25,000. So your total basis as of right now is $200,000, your $25,000 in upgrades, your $20,000 initial closing costs, and again, your $25,000 in final closing costs for a grand total of $270,000. So this is your basis. This is what's going to be used for right now to offset this sales price of $300,000. So right now you're probably thinking, okay, so I sold it for $300, my basis is $270, so I'm really only going to be taxed $30,000. But I want to remind everyone that one of the coolest things about real estate is depreciation, but it does play a huge factor in the amount that you get taxed. So typically, a residential property, we're talking about a 1 to 4 unit property, so it could be a single family, duplex, triplex, or quadplex, is depreciated over 27 and a half years. So let's talk about what that means. Basically, the way the IRS sees it is that your rental property, its useful life in their eyes is 27 and a half years. For a commercial property, it's 39 years. But we're going to be talking about, let's just say this was a triplex. So we're going to use the 27 and a half years. So if you bought it for $200,000, and let's make sure we're talking about depreciation. Okay, so $200,000 over 27.5 years is $7,272 a year. When you own the property, this is very, very cool. This offsets any earned income from the property. So let's just take for example, you have this triplex and it's going to be earning $1,000 a month, right? So for a grand total of $3,000 a month or $36,000 a year. Now, we know that we can offset that $36,000 with items like upgrades, right? Did you do repairs to the property? You likely have a mortgage. Mortgage rates are pretty high, so you're going to be paying a decent amount of interest, but that's deductible, right? So items like repairs, mortgage interest, that's all deductible off of this $36,000 that you earn throughout the year, renting your triplex for $1,000 a month, each unit. So let's just say that those items, the upgrades, the mortgage interest and everything that you're able to deduct is $20,000 a year. So you earn 36, but those deductible items are 20, so your net so far is 16,000. We all know that real estate appreciates. Generally speaking, every year your property is worth more. But the really cool thing is that the IRS lets you depreciate your property over those 27 and a half years if it's a residential property. So picture that. Your property is appreciating against the market, the current market, the values of the market, but the IRS is letting you depreciate your property. So in this example, you're able to depreciate $7,272 a year. So we're going to take this $16,000 net minus 7,272, which equals 8,728. Now, this true net is what you'll be taxed on. So even though you earned 36 and you actually spent 20,000, physically spent those $20,000, which brought your initial net down to 16, this money you never spent. You never opened your checkbook or you took out your wallet to spend this money, but the IRS lets you deduct that against your income, which brings your net down to this. Very, very cool. But what's not so cool is that when you sell your property, you have to recapture these, what I like to call phantom expenses, against your tax basis. So we know that we held it for 3 years and then we sold it. So I'm going to adjust this basis. So I'm going to adjusted basis. of 270,000. And remember, I'm going to be subtracting this new depreciation figure. So 7,272 times 3 is 21,816. And again, that is 72 times those 3 years that you kept the property. In the comments below, message me how long you typically keep a property. For us, honestly, it's usually not more than 3 years. Some people keep them for, a number of years, 15, 20 years, but I'm always interested to see how long people typically keep their own properties. So we're going to take this figure and we're going to subtract, and we're going to get 248,184. Okay, and now that is the true adjusted basis for the sale of this property. So what's this all mean now? Now, this means we're going to take this $300,000 sales price and we're going to take it away from this 248,184. So the sales price of 300,000 minus what I like to call adjusted basis of 248,184 for a grand total of 51,816. That number right there is the number that you're going to be taxed on. But we have to break that down a little bit further. So 51,816 we know is comprised of two things. One, the depreciation figure, which we have here, which was 7,272 times 3 years for a grand total of 21,816. Now, if we take 51,816 minus 21,816, we get $30,000 even. Where did that number come from? That is that number before we added in the depreciation. So remember, we were at 270 for a basis against our $300,000 sales price. 300 minus 270 is that $30,000. So from there, we're going to break down these two things. We know that we're going to be taxed on $51,816, but these two numbers are taxed a little bit differently. So let's talk about this first $30,000 figure. Typically, and this depends on how much you make, but if you're making between, say, $45,000 and almost $500,000 a year, you're going to be taxed at a 15% rate. What rate is that? That's the long-term capital gains rate. And actually, I'm curious about this too. If you're willing, let me know how much your adjusted income is per year. Do you fall in between the $45,000 and $500,000 range? Because that's where this 15% comes in. If you're above that, say, $500,000 mark, you actually pay a little bit more. You pay 20% on long-term capital gains. But if you're in between that $45,000 and $500,000 mark, which is quite a big range, you're going to be looking at 15%. So long-term capital gains is the sale of an asset that you've held for longer than 1 year. Short-term capital gains is something that you sold that you held for less than 1 year. But we're talking about 3 years, which is greater than 1. So we're going to be taxed at 15%. The 21,816, which is the other part of this, is actually going to be taxed differently. And that's going to be 21,816. And that's going to be at an ordinary income rate not to exceed 25%. So we're going to use 25%. That number is 5454. This number here is 4,500. Now, the grand total for your tax is going to be the sum of those two, which is 9,954. So you originally purchased a property for $300,000. You added $25,000 in upgrades. You had other items to boost your basis, which were 2 sets of closing costs, one of which was $25,000, one was $20,000, for a grand total of $270,000. But you kept for 3 years and you enjoyed that depreciation of $7,272 per year. So we had to remove that number from your basis to get an adjusted basis of approximately $250,000 from your sales price, and your adjusted basis came approximately $50,000 in tax, of which $30,000 is tax at a long-term capital gains rate because you held for more than 1 year. You held for 3 years. And the other part, the 21,816, which was the depreciation factor, is going to be taxed at 25%. And so you're looking at approximately $10,000 in taxes due on the sale of an asset that you sold for $300,000, you bought for $200,000, and you put these items in as upgrades and costs. So, a couple other things to consider are many states, most states, also have sales tax, income tax on assets that are sold like this one. In Connecticut, I'm in Connecticut, we're going to add another 7% on top of this. Not great, but that's the reality. If you don't like it, buy in states like Texas, right? No income tax. Better yet, though, we can remove all of this talk. All of this talk can be removed, no taxes due, if we utilize something that's called a 1031 exchange. Super powerful tool. I've used it many times, love it. It's relatively easy to accomplish, and it's relatively cheap to do. For more information on the 1031 exchange, don't forget to check out our podcast. A new episode drops every Tuesday. We talk a lot about the 1031 exchange. Stay tuned for additional YouTube videos on this super, super powerful tool. And remember, sky's the limit, dive deep, and invest how you want to live.